Hey, what's up guys, it's the Average Joe here. In today's video, I'm going to be showing you the trades which I placed this past week. If you enjoyed today's video, please remember to like and subscribe as it really helps out my channel. And if you would like to see more videos which are similar to this, please let me know in the comment section below. But anyways, let's get right in. Firstly, last week was from Monday the 17th of August up until Friday the 21st of August. And as you can see, I placed 5 trades, won 4 trades, and lost 1. And we will be looking at each trade individually, and I will be explaining to you the exact reasons as to why I got in the market. Don't worry too much about the amounts that I made or lost on each trade. What's more important is the method I used to place these trades. It's okay if you don't understand exactly everything that I speak about in these trades, because we still have to cover a lot of my Forex for Beginners series. Please also note that the strategies I will be teaching you will be more structured than the trades I will show you now. I am simply able to see these, if you could call it, opportunities based on my experience through trial and error in the Forex market over a long period of time. And as you can also see here, with the first 3 trades, I was taking up bearish positions in the euro against US dollar market. So let's have a look at what was happening in these markets. Trade 1. This screen may appear overwhelming at first, but I will explain to you exactly what is happening here. First of all, what we are looking at is a euro versus US dollar 4-hour chart. That means each candle represents 4 hours of price movement. And what we can also see is that the market was in a long-term uptrend. And what appeared to be happening is that the bulls were running out of momentum to drive the market up, and that the bears were about to take over the market and bring the price down. And for this reason, I was looking for a sell entry into the market. And what looked to be appearing was a king's crown reversal, which is also known as a head and shoulders pattern. It gets its name from its appearance of a king's crown or head and shoulders. And at the time of me trading, this is what the market looked like. We had a left shoulder, a head, and a right shoulder, which seemed to be appearing. And I suspected the market was about to reverse directions and come down. And this is exactly what I anticipated to happen. Firstly, the market would continue dipping until it hit this red trend line. Then I would exit the trade buying. Then if the market bounced on the underside of this trend line, I would place a new trade entering selling first, with my take profit at the purple line, as indicated here in this diagram, which explains it clearly. Right here I entered selling. So you may be asking yourself, what are the exact reasons I used for entering this market right here? So firstly, I suspected a right shoulder of the head and shoulders pattern was forming. Secondly, we had a bearish engulfing candle. Thirdly, we had a long wick on the north side of this bearish engulfing candle, which, as I previously mentioned, is an indication of a possible market reversal. And reason number 4, the market was in the sell zone on the stochastic oscillator. So you may be asking yourself, what is a stochastic oscillator? It's basically this indicator at the bottom of the screen here, and I will be speaking about it in a lot of detail in a later video, but it basically works on the principle of when the market is between the 80 and the 100 zone on the stochastic oscillator, you should look to sell. And when it's between 0 and 20 on the stochastic oscillator, you should look to buy. What actually happened is that I entered the market too early, and the head and shoulders formation did not hold, and the market continued rallying. That's trade 1. Now if we look at trades 2 and 3, what you can see is that I was back in the same euro against US dollar market, and I was still looking to sell. However, this time it paid off. So with trades 2 and 3, I'm going to explain it as one trade, because I entered selling, exited the market to secure my profits, and then re-entered the same market selling again. A quick disclaimer, you don't actually have to exit the market to secure your profits. You can simply adjust your stop loss to a lower point and essentially secure your profits. With this trade, I essentially entered selling at 1.9241 and exited buying at 1.18177, which is more than a 1,000 pip price movement, which is very large considering I was in the market for less than 24 hours. As I mentioned in trade 1, which was in the same market, the bulls were running out of momentum to drive the market up, and the bears were about to take over and bring the price down. And for this reason, once again, I was looking for a sell entry. So why did I enter selling here? There are 2 main reasons for this. Firstly, because tweezer tops appeared, and secondly, because the market was in the sell zone on the stochastic oscillator. As you can see in retrospect, the market continued dipping to about a price of 1.17560. However, I didn't know it would happen. At the time of exiting, there was no indication that the market would continue dipping, and it actually appeared to be reversing Most importantly, I was satisfied with how much I had already made on the trade, and I wasn't driven by greed because I know there will be unlimited trading opportunities to come in the future. So that's trade 2 and 3. Trade 4 and 5. With trades 4 and 5, I was trading the Great Britain pound against the Japanese yen. So let's have a look at what was happening in the market. Firstly, we are looking at a 4-hour chart, which means each candle represents 4 hours of price movement. Something also that I want you to take note of is that the market is in consolidation, meaning it is moving sideways. So how can I see this? Well, from the period of the 13th of August to the 20th of August, the market was stuck in a price range, and this price range is represented by these two red lines. What consolidation tells a trader is that the market is closely being contested by the bulls and the bears. With this in mind, let's have a look at trade 4. With trade 4, I entered buying during this consolidation. As you can see, I entered right here. And I wanted to ride the market up and get out just where the price range ends, at the top of the consolidation. So why did I enter here? Well, because I was trading consolidation, I only really needed one reason to enter, due to the fact that I had a pretty good idea of where the market would go. However, on this particular trade, I had two reasons to enter buying. Firstly, because tweezer bottoms formed here, and secondly, because the stochastic oscillator was in the buy zone. And the market did exactly what I suspected it would do, and I took my profit just before it U-turned and came down again. That's trade 4, which is fairly straightforward. Now with trade 5, I entered selling during this consolidation, and as you can see, I entered right here. And I wanted to ride the market down and get out just above where the price range ends, at the bottom of the consolidation. So why did I enter selling here? As I mentioned earlier, I only really need one reason to enter during consolidation. And the reason I entered selling here was because the stochastic oscillator was in the sell zone. But also what later formed after I entered the market was an evening star, which just provided further confirmation that the market would dip. And the market did exactly what I suspected it would do, and I took my profit out just before the U-turn and went up again. That's trade 5, which was a nice way to end a Friday afternoon. What I like about trading consolidation is that you can place your stop loss very close to where you enter the market and essentially risk very little in comparison to how much you could potentially make on that given trade. This holds true because when trading consolidation, you place your stop loss order just outside of the consolidation price range. And why you do this is because if the market leaves the price range, it is no longer in consolidation and will most likely continue breaking out in that direction. But also what this trade showed you is that you can make just as much money when the market comes down as you did when the market went up. But we can't just end the video there. So let me show you one bonus trade, and let's fast forward to this week. And I will show you the trade I placed on the day of this recording, which is Monday the 24th of August. And as you can see here, I entered buying the euro against the Japanese yen. So let's see what's happening in the market. Why I wanted to show you this trade was not only because the trade was successful, but more importantly, this is the main strategy which I will be teaching you in my Forex for Beginners series. Everything that is on screen now is hopefully what I want you to be able to do on your own. And this strategy is called the ABCDs. What I like about this strategy is firstly that it incorporates so many different aspects of trading into a single strategy, but also because your entry and exit points in the market are so clear. So why did I enter buying in this market? There were actually quite a few reasons. However, the two reasons which you should understand by now is that firstly tweezer bottoms appeared, but also the stochastic oscillator was in the buy zone. However, other reasons include that the market was in the up AB boundary and that past resistance became future support, but we will speak about these reasons in a later video. Alright guys, that's going to do it for this video. Once again, if you enjoyed today's video, please remember to like and subscribe. And part 5 in my Forex for Beginners series will be continuing next Wednesday. And until then, stay safe and strive to be more than average.